Mitigate market crash drawdowns with options. A stock market crash occurs when there's a significant decline in stock prices. While there's no specific numeric definition of a stock market crash, the term usually applies to occasions in which the major stock market indices lose more than 10% of their value in a relatively short time period. Preventing portfolio drawdowns is important for several reasons. Number one, preserving capital. When a portfolio experiences a drawdown, the value of the portfolio decreases, and this can be especially problematic for investors who are relying on the portfolio for income or who have a short-term investment horizon. Preventing drawdowns can help preserve capital and avoid losses that could be difficult to recover from. Number two, reducing emotional stress. Drawdowns can be emotionally challenging for investors. When a portfolio loses value, investors may feel anxious, stressed, or panicked. Preventing drawdowns can help reduce emotional stress and help investors stick to their long-term investment strategy. Number three, mitigating the impact of sequence risk. Sequence risk is the risk that an investor will experience poor investment returns early in their retirement, which can significantly impact their ability to fund their retirement lifestyle. By preventing drawdowns, investors can reduce the impact of sequence risk and help ensure a more predictable retirement income stream. And number four, enhancing long-term returns. When a portfolio experiences a drawdown, it can take a significant amount of time to recover. By preventing drawdowns, investors can avoid prolonged periods of poor performance and enhance their long-term returns. When it comes to options and selling premium, there are different types of crash markets that are significant. And since the global financial crisis of 2008, the stock market has experienced a number of significant crashes. In particular, there have been four major market crashes in the past decade or so. First, the fall of 2008. Then there was August 24th, 2015, and February 5th, 2018, and March of 2020. Each of these crashes had a significant impact on the financial markets and investors. And understanding their duration and recovery periods is important for investors looking to manage their portfolios effectively. The 2008 market crash was one of the most severe market crashes in history. It took several years for the market to recover. The crash began in October 2007 and continued until March of 2009, lasting nearly 18 months. However, it took even longer for the market to recover to new highs. In fact, it wasn't until March of 2013, more than 5 years later, that the market finally surpassed its pre-crash levels. The August 24th, 2015 crash was caused by concerns about slowing growth in China, and it took the market nearly a year to fully recover. The crash began in July 2015 and continued until June of 2016. During this time, the market experienced significant volatility and uncertainty as investors grappled with the implications of the Chinese slowdown. The February 5th, 2018 crash was caused by concerns about rising interest rates and inflation, and it took the market about 7 months to recover to new highs. The crash began in late January 2018 and continued until late August of 2018, lasting again nearly 7 months. Now, during this time, the market experienced significant volatility as investors weighed the potential impact of rising interest rates on corporate profits and economic growth. Now, finally, the March 2020 crash was caused by the outbreak of COVID-19, and it took the market about 7 months to recover to new highs. The crash began in mid-February and continued until mid-August. Now, during this time, the market experienced significant volatility as investors grappled with the implications of the pandemic for the global economy and corporate profits. One of the biggest challenges that investors faced is recovering from drawdowns after market crashes. If an investor experiences a 50% drawdown, they will need a 100% return just to break even. This uphill climb can take years and significantly impact the growth potential of a portfolio. As an investor, I understand the challenge of recovering from drawdowns after market crashes. It can take years to climb back to even. And during that time, your money isn't really working for you. And that's why I believe it's crucial to keep drawdowns to a minimum in order to achieve good growth in my portfolio. Now, how to hedge the portfolio. In my search for ways to minimize drawdowns and recover quickly from market crashes, I've discovered advanced options trading methods like the Synthetic Dragon and the Premier Level 5. These systems draw down during the initial leg of the crash due to negative vega and concavity, but they have a built-in hedge and single ticket order structure that helps to prevent further risk. Since 2018, I have implemented a single ticket order approach and a proactively hedged options trade structure to minimize my recovery time following market crashes. My backtest conducted in 2008 showed no drawdowns, and in August of 2015 and February 5th of 2018, the system bounced back within a day or two. Now, even though my backtest during 2020 crash showed a drawdown of around 15%, I was able to recover back to even within 2 to 3 weeks. However, I experienced a more significant drawdown, 33%, in my actual account due to implementing a large risk-on style, which I later changed to my current and backtested campaign style trade system. Now, despite this setback, I earned over $100,000 in profits in March of 2020 in my real account. Although it took several months to get back to even like the market, I attribute this success, at least in part, to my single ticket order positions and my proactive hedges. In conclusion, preventing portfolio drawdowns is crucial for investors for several reasons, and it helps to preserve capital, reduce emotional stress, mitigate the impact of sequence risk, and enhance long-term returns. The past decade has seen several significant market crashes, and recovering from drawdowns can take several years, negatively affecting portfolio growth. As an investor, I have discovered advanced options trading methods like the Synthetic Dragon and the Premier Level 5 systems that can help prevent risk during market crashes by utilizing single ticket order positions and proactive hedges to minimize drawdowns. I have been able to recover quickly and achieve strong returns. These methods are valuable tools for any investor looking to achieve better growth in their portfolio over the long term. If you're a trader looking for trading consistency, if you keep changing your approach looking to add one more rule that will get you over the top, I'm going to help you for free. Stay with me for the next minute or so. Now, who am I to make this claim? My name is Karl Domm, Karl with a K, and it took me over 20 years to finally succeed to become a profitable options trader. And I have publicly proven to be a profitable trader since I started sharing my P&L on my YouTube channel in May of 2019. Now, my larger options trading account started with $110,000 and now is worth over $165,000. And I'm the only YouTube instructor that shares my daily P&L, proving that I am a profitable options trader. Now, I've asked many other instructors to share their P&L, but they don't because they can't, because they actually lose money trading. And I'm frustrated with the lies being told. If you've ever taken an online trading course, I'm 99% sure that you're frustrated and that you've lost money following these instructors. And you already know that they don't share their P&L. Now, as far as trading myself, I just happen to have a passion for options trading. And I spent over 27 years learning and trading. And I'm not necessarily interested in the technical aspects of options from a scholastic point of view. I've been passionate about the most efficient way options can make me money. And this is my calling in life, as corny as that sounds. And I've even written a book on the subject, even though I hate writing. For some reason, trading ideas just flow into my head all the time, and I take those ideas and I spend hours and hours backtesting them. And after backtesting over 300 ideas, one of the trades I developed was a trade that I call the 2060. This is a proprietary trade I developed almost from scratch. I initially created the course to sell it, and I wanted to compete with these other YouTubers that were frustrating me with their fake claims. But what I've decided is I want to do what it takes to expose those YouTube fake gurus.
And if I could offer something for free that is vastly superior to their paid products, maybe I could put a dent in their business, which in effect would be using my talents to help people. Because of this, I'm currently providing the 2060 course at no cost. And this is a full course. It's not a worthless free report or some piece of useless, non-actionable information. This is a full course with black and white rules. Rules that you can use to take action and learn how profitable options traders trade. This course is worth $495, but I'm giving it away today for free. See the link in the description to sign up for the course.